In this video, we're going to discuss some important concepts and definitions that you need to know. I want to make sure that we're on the same page when I go through these definitions and terms, though. This video is a complement to, and not a substitute for, going into a textbook, looking up these definitions and concepts, and writing down the textbook definition. That's what you need to do either before or after this video in order to put my comments in context. I am not a machine who's going to sit here and just read textbook definitions to you. My job in this video is to try to put these things in a little more context and to point out some little trouble spots that a lot of people have and some examples to make this easier to understand. But do make sure you go through that extra step of actually going through, looking these terms up in the chapter of your textbook and writing them down. Then what I say will make a lot more sense. So in our last video, what we did is we looked at going from utility analysis to production analysis. We saw how some of the mathematical techniques and some of the graphs are going to translate over very nicely. But let's focus on some basic concepts. Again, I assume that you've heard these concepts before in like an introductory microeconomics class, but this is a review and also just to try to give you some examples about how some of these things are important and some things that are commonly confused. So first thing, whenever we're talking about the costs of a business, one way, there are lots of ways we're going to do this, but one way we want to divide these costs into different categories is some costs are explicit and some are implicit. What does the word explicit mean? I want you to think about explicit movie, explicit lyrics in a song. Explicit means it is obvious, it is there for anybody to see. It's not hidden in any way. So explicit cost is a cost that is right there, it's obvious, and it's out in the open for everybody to see. An implicit cost is still a real cost of a business, but it's just not one that is as obvious, as open for everyone to see. The real way that you should think about breaking these costs into the two categories are explicit costs are mostly things that an accountant would see. This is not a perfect synonym for an accounting cost, but it's pretty similar. So let's write that here, accounting. Now, what's the job of an accountant? The whole reason accountants exist is so that they can track the money flowing in and flowing out of a business. That's really what their job is. Now, they do some other things like help you figure out your tax bill, but the accounting profession really got founded to try to help people keep track of the flows of money flowing in and flowing out, to make sure the money goes where it's supposed to go, and to try to prevent money from disappearing into employees' pockets, and to try to make sure that people who owe you money actually pay you the money on time. So an accounting cost or an explicit cost are things where you can see the money moving. So an explicit cost is anything where money actually changes hands. You can see money move from one person to another. Now, when I say money, I'm not just talking about hard cash. This could be a credit card transaction, a check, an automated clearinghouse bank transaction. Anytime when any money moves from one person's account to another or from one person's hand to another, this is going to be an explicit cost of a business. So think about all the things a business does where they have to take money and give it to someone. Either check, charge, bank transfer, paying their employees, paying their electric bill, paying their insurance bill, paying their taxes. All these things where you actually have to pay money out of the business. Now, what other kinds of costs would there be where you don't actually pay money? Well, these are the implicit costs. An implicit cost is most often a case where instead of money flowing from one person to another, the money doesn't flow to the business. And in that sense, it's a cost. The classic example of an implicit cost would be you're an entrepreneur and you quit your job to start a business. How much money did you used to make before you quit your job and started this business? Well, if you used to make $50,000 a year, but you no longer make $50,000 a year, and you had to quit your job in order to start this business. Question number one, is that really a cost that you incurred to do business? Yes, it is. You really gave up that $50,000. Why is it not an explicit cost? Because you don't see the $50,000 moving anywhere. It's the fact that it's not moving is what makes it a cost, okay? So that's one good example of an implicit cost. You give up one stream of income in order to get into a certain kind of business, then that is an implicit cost. You really are losing that money. It really is a cost to you, but an accountant isn't going to see the $50,000 going anywhere, so they're not going to think about it as a cost in their books. So this is a kind of thing that an economist would normally think about as an opportunity cost. You gave up the opportunity to make the $50,000 so that you could start this business. As we'll talk about in a second, opportunity costs aren't really that limited. Another example of an implicit cost would be, okay, what if your grandfather died and left you the family farm? What are the choices about what you could do with that family farm? Number one, you could keep the family farm and use it to grow mangoes or something like that. Now, if you keep the family farm and use it to grow mangoes, what are you giving up the opportunity to do? What are some other things you could do to bring in some money? Well, you could have taken that family farm and sold it, say for $1 million, and you invest that $1 million. The expected amount of return and interest and profits or whatever that you could get investing the money would be an implicit cost. You could, instead of selling the farm, you could rent the farm out to someone else. Then the implicit cost would be the money you could have made renting the farm out to someone else. The fact that you're using the farm in a business rather than renting it out or selling it and investing the money, these are implicit costs of using the farm yourself. So again, these are real costs, real amounts of money that you really are losing, that it really is costing you. It's just we don't see the money flowing from one person to another. An accountant wouldn't track it. The next type of cost we want to think about is a sunk cost. Now we call a sunk cost because it is just like you took money and threw it off a boat and it sunk to the bottom of the ocean. The formal definition of a sunk cost is any cost where the money is gone and irretrievable. You can never get it back. What's important about a sunk cost is, since you've already spent the money and you can never get it back, the rule economists want you to always think about is ignore them for future decisions. So sunk costs, since it's money that is permanently gone, it cannot be affected by anything we do, and therefore we need to ignore it when we make future decisions. Let me give you a quick personal example about a sunk cost. A few years ago, my wife and I were going out to dinner with some friends every month or so just to get together, and there was an opera coming to town. And my wife and I had never been to an opera before, and we think about ourselves as being cultured people. And we said, hey, how about we get tickets to the opera? And hey, how about we ask those people that are friends of ours to get some tickets too? And we can go out to dinner, then we go out to the opera and have a great old time. So we bought some tickets, they bought some tickets. The tickets weren't together. We went out to dinner, had a great dinner. We went to the opera. The opera started at 8 o'clock. We sat down in our seats, and the other couple was somewhere else in the auditorium. We couldn't see them, they were so far away. And the first half of the opera lasted from 8 o'clock until 11 o'clock at night. Now, this opera was in Italian, and although I do speak some Spanish, and sometimes when I hear Italian, I can translate it in my head, when people are singing Italian, it just doesn't work that way. Now, at these operas, they have translations for you. They had this big screen above the stage where they were projecting the translation up there for everybody. And these translations were fine for about the first 10 minutes, and then they got stuck. So for 2 hours and 50 minutes, Something was going on stage and everybody was running around and they were singing in Italian, but all we knew was that someone was under a table, because that was the translation that was up there for 2 hours and 50 minutes is he's under the table, exclamation point. So as 11 o'clock rolls around and finally it gets to intermission, I turn to my wife and I say, "Dear, we need to go." She's like, "What do you mean we need to go?" So, "Are you enjoying this?" She says, "No, I'm not enjoying this, but we can't leave. We paid a lot of money for these tickets." And I said, "Dear, it's finally my time to shine. I'm an economist. Let me tell you that the money we paid for those tickets is a sunk cost. It's money we spent. We're never going to get it back. Economics is the science of decision making. What we have to do right now is view our costs and our benefits going forward. We have to look at future money and future time." And so I said, as I see it, we have two choices. We can go to intermission for 15 minutes, come back, sit down at 11:15 or 11:20, and as far as I know, we have another 3 hours of this. Sitting here listening to the opera. We weren't really digging the music that much. We didn't understand what was going on. It was getting really late. So we have the choice of watching the opera. It's not going to cost us any more money. Those tickets are gone. Or we could leave. So if we stay there for another 2 or 3 hours and watch the opera, we knew we would be miserable. If we leave, we could go do something else fun and enjoy ourselves. So what are the additional costs and the additional benefits here? And she said, "Okay, I understand about the tickets, but here's the big problem. What about the other couple? They're going to think that we just don't know what we're doing if we leave the opera, and what if they see us leaving?" I said, "Okay, run for it." So we run for it, and we go out to a restaurant, we have a glass of wine, have some cheese, we have a great old time. The next time we see this couple, we both kind of hint around talking about that last time we saw each other at the opera, and eventually it came out that they left at intermission too. They weren't having a good time. So we had a good laugh about that. Long story short, if you've already spent money and it's gone, it should not cloud your future decisions. I don't care if you spent $1 million for those tickets. At the point where you can't get your money back anymore, you need to consider it a sunk cost and decide from that point forward whether you should stay or go. Now, another example that is a little more common, say, in the government world. Sometimes it happens that the government will decide to build a bridge or build a road somewhere. And maybe they should never have started building the road to begin with. It gets to the point where the road is 90% completed, and you need to spend another $1 million to complete the road. Perhaps you've already spent $99 million on the road. All it takes is another $1 million in appropriations from the government to finish this road. Should you spend the extra $1 million to finish the road? A lot of people would say, "Well, you've already spent $99 million. What's another million?" An economist would say, "Okay, the $99 million is sunk. Ignore it." At this moment, we have a choice to make. If we spend another $1 million, we'll have a completed road. If we don't spend the $1 million, we won't. The real question is, how much is the completed road worth? If the completed road is worth more than $1 million, in, say, reduced travel time, convenience, safety, maybe, then sure, spend the $1 million. But if the completed road isn't going to benefit anyone and it was a road that just should have never been built in the first place, then don't spend the $1 million. The $99 million is sunk. Look at the future costs and the future benefits to judge your decisions. A good example in the business world of a sunk cost that might be interesting would be, what if you're in a business and you spend $1 million to develop a new product? Should you keep developing the product? Well, again, the fact that you've spent $1 million on it is irrelevant. What you need to do on a daily basis is ask yourself, if I spend more money developing this product, will the result be that the benefits of spending more money exceeds the costs of spending more money? The fact that you've already spent $1 million, it really is irrelevant. If you can spend another $1 million and the result will be worth $2 million, great. If you can spend another $1 million and the outcome will be $1.5 million in benefits, great, do it. But if you're going to spend another $1 million and the end result will only be a product that you think you can make $500,000 off of, then drop the project. Don't throw more good money after bad. So the saying that economists have about sunk costs is, remember that sunk costs are sunk. Don't think about them for future decision making. Now, if you're about to spend money that's going to be a sunk cost, well, that's still important because you haven't spent it yet. It's not sunk yet. All right, what about fixed costs versus variable costs? This is another way to break costs into two different categories. Explicit versus implicit is one way to look at it. A very different way to categorize costs, fixed versus variable. A variable cost is anything that costs you more as you produce more units of a good. A fixed cost is anything that does not cost more as you produce more units of a good. Simply, when we think about variable costs, most of the time we're thinking about things like labor and materials. Now there are other things, but the easiest way to start, think about labor and materials. When you produce more of a good, you're going to use more worker hours. You're going to have to pay those workers more money, probably. And if you do, that's a variable cost. You're going to have to use more materials that go into making the product. Perhaps more electricity. Perhaps more plastic or steel or rubber or whatever that goes into making this product. Labor and materials are things that are usually going to be variable costs. How do you tell? You just go ask a business person. What do you spend more money on when you make more goods or produce more services? Those are variable costs. Fixed costs, anything that doesn't cost more. What are examples of fixed costs? I usually say things like rent are things that are fixed costs. Just because you're producing more units in a factory today doesn't mean that your rent for your factory will increase. Also, salaried employees. No matter how many hours I work, I get paid the same amount. So salaried employees, management level people, fixed costs. But hourly employees, or people who get paid on a piece rate, so you pay them $1 per unit they produce, those are going to be variable costs. So we talked about this a little bit before, but let's come back to it. Accounting costs. An accounting cost is something that the accountant is going to put in their books. Accounting costs, let's think about being in two categories. Accounting costs are going to be things that are explicit costs. One other thing that accountants will take into account that is not an explicit cost is depreciation. So depreciation is the idea that, say you buy a truck to use in your business. The truck costs $100,000. Accountants every year will say, okay, we own this truck, it costs $100,000. But if we use it for 1 year in the business, the truck will be worth a little less. How much less? Now, here's where economists and accountants differ a little bit. So let's skip down here a little bit and talk about these two items. Accountants generally, in the United States at least, but in most countries it'll be a similar idea, they use some kind of rules that either the tax law has created, or in the United States they'll use something called Generally Accepted Accounting Principles, GAAP. And what an accountant does is they look up in a book, okay, this is a truck, it's a heavy truck, and a heavy truck says you have a few choices about how you can depreciate it, but the easiest way might be to depreciate the truck 1/10 of the value every year. So if the truck costs $100,000, then this book that accountants are required to use by law might say, in the first year, the value of the truck depreciated or went down by 10%, $10,000 in the first year, $10,000 in the second year, $10,000 in the third year. And then what this book would say is this truck has no value, at least according to the accountant's books, after 10 years. The truck is worthless. Depreciation is a real cost of doing business. Again, you can think about, well, if I had this truck, this $100,000 truck, it will lose value over time in the business as I use it. But if I didn't own this truck, then I'd still have my original $100,000 and it would not lose its value over time like the truck does. So it's an implicit cost, but it's nevertheless a real cost. How does this differ from how an economist would like to think about the idea of depreciation? What an economist would rather we do is, instead of looking in a book, and the book says, assume for the sake of simplicity that a truck loses 10% of its value every year, and after 10 years it has zero value. What an economist would rather do, even though it's going to be more complicated, is to say, okay, you bought the truck for $100,000, use the truck for a year, and then go get the truck appraised. See how much you could really sell the truck for. Now, maybe when you go get the truck appraised, and you see that the truck is really worth $83,000, $741 after 1 year. Then the depreciation would not be $10,000. It would be how much is the value of the truck really gone down over the course of using it in the business for a year. And in this case, it would be something like, $16,259. The only difference here is economists really want to try to measure how much did it really cost you in the value of the truck because you used it for a year. Now, in the real world, this probably isn't practical, and this is why accountants don't do this. They don't go and appraise and get the approximate sales value for every computer and every truck and every desk in the business. And an economist probably wouldn't do this either. But we would probably, if we were doing this, try to get as realistic a resale value on things as we could without spending all day every day trying to obsess over getting it perfectly right. So long story short, the proper way to look at depreciation in making decisions, you want to know, should I use this truck in my business? And that's going to come down to the real cost and the real benefit. The real cost of using an asset is how much the value decreases over the course of a year. And you want to compare that to the benefit of using that asset in the business, and only use it if the benefit is bigger than or equal to the cost. So the next thing I want to talk about is opportunity cost. Now, in an introductory microeconomics class, usually you think about opportunity cost as meaning the value of the next best thing given up. So if you choose to go to class on a certain day, then the opportunity cost is, well, what is the best thing you would have been doing if you hadn't gone to class? The value of the second best thing or the next best thing. When we get into intermediate microeconomics, we want to make you think a little more carefully about opportunity cost. Think about a business and all the resources they use, the land, the labor, the capital, and the entrepreneurship. Every bit of resources that you use in a business to produce a good, produce a service, is an opportunity cost. What do you mean? Well, because the business didn't have to use the land, the labor, the capital, and the entrepreneurship in business A, where you're producing trucks. Those same resources could have been used in a different kind of business. So we want you to think about viewing all costs of a business as an opportunity cost. So think about them as just economic costs. What are all the costs, including the explicit costs and the implicit costs of doing business? When we talk about opportunity costs or economic costs, we want to think about the real value of depreciation, right? Not looking it up in a table that might give us some fake simplistic value. We want to try to think about, at least, even if we don't know the true value, the real value of every asset that's lost by using it in a business. We want to account for all the implicit costs and all the explicit costs. And all these, if we use them in our business and they could have been used for something else, they're all opportunity costs. They're all economic costs. All right, now let's think about the difference between how an accountant might calculate profit and how an economist might think about calculating profit. They really are, very importantly, calculated two different ways, and they really mean two very different things. So make sure you pay close attention to this. And to help us visualize what's going on here, here's a little picture that I like to use to get us to think about what's going on. Both of these rectangles here are our total revenue, okay? Price times quantity. So let's suppose if we think about this, then let's think about the x-axis as being quantity here, right? So in both cases, we're selling the same amount of a good. So maybe this is 100 units of a good, and then the height is the price. And so we're just thinking about a total revenue rectangle here. And maybe the height is $50, and the entire area is our total revenue. 50 times 100, $5,000. But the way we think about splitting up this total revenue to get what we are going to think about calling profit is going to be a very different procedure. Let's look on the right. Suppose you go to your accountant and say, hey, I made $5,000 in revenue. So that's the entire rectangle here. The accountant's going to say, okay, can you give me your receipts for your payroll and the receipts for your electric bill and your insurance and all the other things, and I'll calculate your accounting profit for you. You give your receipts to your accountant, and he says, okay, well, your explicit costs, your accounting costs were $2,500. Plus, this graph kind of sells accountants short just a little bit. Your accountant says, oh, and there's this other thing, not just explicit costs that we look at, we also look at depreciation. And I looked your equipment up in these tables, and these tables told me that your depreciation was $500. So this is accounting depreciation. So the accountant says your profit is the total $5,000 in revenue minus your explicit costs minus a little bit for depreciation, and your accounting profit then is going to be $5,000 minus $3,000. Right? $3,000 is your explicit costs plus that depreciation. So $2,000 in accounting profit here. Well, what we do, let's assume that it just so happens that the way an economist calculates your depreciation is the same as what the accountant did. So you know what? Strangely enough, that table said to subtract $500 for depreciation, and the real market value of your assets actually did decrease by exactly $500. That's going to be rare, but to make this as simple as we can, let's suppose that happened. And so if we look at this top part here, this is going to be the $2,000 that your accountant said you had in profit. Here's the problem. Your accountant did not count some implicit costs. Sure, they got the depreciation right, but what are some other implicit costs? Well, the accountant doesn't know and isn't going to ask, did you quit that job that you had as a teacher to start this business? Oh, okay, well, how much money did you give up in that lost income in order to start this business? They're not going to subtract that implicit cost. And then he's not going to ask you, oh, wait, your business is on Grandpa's old farm, right? Oh, well, you know, if you didn't use Grandpa's old farm for your business, how much could you rent that out for? Or, oh, what if you sold Grandpa's farm, you invested the money, how much lost revenue, how much lost investment income are you losing because you're using Grandpa's farm in your business? He's not going to be subtracting those things. An economist would. What the economist is trying to get at is get you to compare how much money you're making in your business compared to how much you could make if you shut the business down and did the next best thing. So what you could do as an alternative, sell Grandpa's farm, invest the money, shut the business down, and go get your job back. We want to compare what are you doing now, how much profit are you earning now, compared to how much profit you could be making if you did the next best thing with all of your resources. Now let's suppose that the next best thing, if we include all those implicit costs, that would add another $1,000. Then the economist would calculate that out of this $2,000 in profit that the accountant said you had, you're really making what we'd call a $1,000 economic profit. What does economic profit mean? Economic profit means how much more or less money you're making in your business compared to the best you could do in another opportunity. So this is why we think about all business costs as opportunity costs, because you could not spend any of this money by getting out of this business, and you could take advantage of all those next best opportunities, right? So if you're making $1,000 economic profit, what that literally means in an economics class, anytime we say profit, we're talking about economic profit. And that $1,000 means you're making $1,000 more in this business than you could make if you shut the business down and used all your resources to their highest purpose somewhere else. What if you were making zero economic profit? Would you be sad? The answer is no. If you're making zero economic profit, you are fine. You're not dancing in the streets jumping for joy, but you're not crying either. Zero economic profit just means, oh, okay, I'm doing the best I can. I'm not making any more money or less money than I could make doing anything else. So you're doing the best you can. That's no reason to be sad, right? Now, if you had a negative economic profit, so here's what we'd be saying here is your accountant says you're making $2,000. But when you think about it, you say, hey, I'm only making $2,000. But if I sold the farm and invested that money, I could make $2,000 from just doing that. And I could take the time that I've been spending, organizing, and managing this business to go get a job somewhere else earning $1,000. And so these implicit costs could be so big that they're bigger than the accounting profit. So what we're doing is taking the accounting profit and just comparing how much you're making, according to your accountant, $2,000, to how much could you make otherwise if you used all your resources somewhere else. And it could be that those implicit costs are $3,000. And in that case, what would be your economic profit? Minus $1,000. And all that minus $1,000 economic profit tells you is you're making $1,000 less in this business than you could if you used your resources in their most productive place. So most of the time in an economics class, the normal situation is going to be to assume that people are making zero economic profit. It doesn't mean that they're sad. It doesn't mean that they're poor. It just means they're doing the best they could. And anytime they're making a positive economic profit, that's a very, very good thing. Anytime they're making a negative economic profit, they're going to be wanting to get out of this business and go do something else. All right, I'm going to end this video here, and I'm going to come back with a second part where we talk about the last few terms and ideas on this sheet. And as always, if you have any questions, let me know. If not, I wish you the best of luck in all your studies, guys. Bye-bye.